Pennies Going in Raw is a production of iHeartRadio. The opinions expressed in the following podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It is only intended to provide education and entertainment about the financial industry and the stock market. Enjoy!
On this episode of Pennies Going in Raw, we have Hugh discussing moving averages, and we discuss this week in the market and more.
You find out life's this game of pennies.
Oh, you guys know we only have a 40% runner. Hello, 40% is a fucking killing.
We've been compliant for too long. It's time we go to war.
I don't have a Roth.
Hugh knows so much about the market that his brain doesn't have enough room for grammar.
Hey, who told me about IDEX? It's going up a shit ton now.
Rob, 4%, baby. No way. 4 fucking percent.
You asked the exact same question with 2 words different.
It's like, man, I just got dick whipped for like 20%, and now that f***er's up like 50.
I bet Warren Buffett never did that.
I'm just making this voice memo to call out unusual whales to a fight.
The pennies we need are everywhere around us.
Pennies.
Going in raw.
Featuring Dan, Deity Dips, and Hugh Honey.
Produced by Vinny.
And Christian.
Let's go, baby.
Welcome back to another episode of Pennies Going in Raw. Today is Sunday, August the 28th, and I mean, we're recording this on Friday after the market ended, and you saw it. SPY dropped $15 fucking dollars, 3% today. Is it back to the chop? Is it like what? It seems like we were finally on the right track, but at the same time, you know, we gave these levels. We said, hey, if it doesn't come here, expect it to drop back here. Is this exactly kind of what we talked about and what we planned on? Or is this kind of an overreaction of a drop? I mean, this Friday drop seems a little aggressive.
So we knew that we needed a pullback, right? Like, I mean, we hit 431 from
3 weeks after 370.
Yeah. And at the end of the day, you know, the Fed was inside that July meeting, the Fed was super bullish. And I get that. However, like we talked about, is that this was kind of like the last string of super bullishness, because if CPI had printed higher, if CPI had printed higher, let's just say, you know, anything happened along CPI, monkeypox, there's so many different things that
it seems hard to take fucking monkeypox seriously with the name monkeypox. Like, it sounds like something from Planet of the Apes.
It's also like sometimes like those terrible hurricanes, and they're like Hurricane Griswold, and it's like what?
Griswold, like it's a category 1, like it's a tropical storm. You don't have to make it fucking Hurricane Alexander the Great. Like, chill.
Yeah, exactly.
Hurricane Katrina doesn't sound super devastating, but that bitch fucked hella people up.
Yeah, still to this day. Yeah,
Harvey, Ivan, Katrina, real casual names.
Sandy. I had like Sandy.
Yeah, I have an aunt. That's like my aunt's name.
Yeah, she's like the sweetest woman. She could never do that.
Yeah, and she would never she would never displace 400,000 people with over 6 inches of water.
Yeah, exactly. So my point to all this is that we knew that we needed a pullback. However, we obviously got this big pullback. You know, the Fed really didn't say anything new, and that's kind of what we've been noticing, right? Is that the Fed's really not saying it. At this point, it's more of just how is the market going to react? You know, especially around earnings season, and especially around like when the Fed is tightening and stuff. You know, the one thing that we always like to remind is that especially with earnings, is that if it's not a complete miss or a complete a complete miss or a complete beat, sometimes the market can kind of do whatever it wants. And what I mean by that is that, when we were saying bad news is good news, and now good news is bad news, that's what I mean, is that just because the market should act a certain way doesn't mean that it has to. And I think that
just because you take your kid to get fucking McDonald's and a Happy Meal doesn't mean he's gonna act good for the rest of the day.
Mm-hmm. Exactly. And the market isn't supposed to make sense, or else everybody would make a hell of a lot of money inside the market. And that's just not the truth. So I think that, today was a really good reminder that the market does what the market wants. And and I hope that you guys were okay, you guys were safe out there, because even if you, like, I saw someone tweet that, like, if any point today that if you went all in on you know SPY 0 days, like, you'd be rich, and the truth of that is just not true. That's just not true. And I hate when I hear stuff like that, because it's so far from the truth, and that's just irresponsible, I think.
Yeah, if you bought at
any
the
and every
bottom and
degree.
sold at the top, you're definitely making money. Like, yeah, we get
Yeah.
it, dude. Fuck off.
Mhm.
So
So
what was surprising to me about today was, like, it wasn't just like the big thing. It wasn't just SPY tanking, It took most things down with it too. Like, it didn't,
yeah,
some of these days, like, you'll have your portfolio pulled up and like, okay, SPY may be down a good bit, but these are still kind of rallying. But it just because it seemed like so many things were not colliding with the market's movements. But now it seems like everything's rolling with it. It seems like things are moving how you'd expect them to, honestly.
yeah, and here's the thing is that, and I'm not going to speculate on if this run from 360 or whatever it was to here was a bear market rally. However, you know, it's what we talked about on Wednesday. Is the average bear market rally, and we were right there. I mean, almost to the dot on the average bear
exact
market
day,
rally.
yeah. 2 months of trading days. I'm 40
Yeah, and
something days.
And the other thing was, yeah, exactly. There was just so many things that aligned, and so that could be playing a part into this as well. Is that again, is that you get enough people thinking the right thing on the right side, and and you could influence the market. And the other thing is that, and we talked about this again on Wednesday, is that it seemed like institutions were loading puts, and so we said that either the market was going to drop heavily, or hedge funds are going to be squeezed, and we could be at 450, 460 pretty fast. And today was the first battle of the war inside this new battleground, and clearly bears
Seems
won.
like it was a decisive victory. It wasn't like why would you say this is the first battle and not like ongoing?
Well, because we've been rallying for a few weeks now, and this was the first time that bears really stepped in. Like we had, like when we were rallying over the past 4 weeks, we had like a few days where it was like we were down 1%, 1.5%, but that was because we were up 7% in the week. Like it was like it felt like it kind of felt like the cost of doing business. Go up 5%, come down 1.5%, go up 5%. So now that we've wiped out 3.3%. And now, we do this one more time, and we're going to be at 390. And now it's like, okay, shit, we do this 2 more times, and we're back at lows very quickly. And again, obviously, I'm not speculating that the market will drop almost 3.5% 2 more days.
4 days in a row, yeah.
Yeah.
But I mean, the fact of the matter, if it goes down 3%, comes up 1%, I mean, you're a week away from lows.
Exactly. And that's the thing, is that the momentum has shifted, because before it was like if the market was green 1%, it was like, great, we're making a step forward. Where now, based on the sentiment that I'm seeing across different platforms, and even what I'm listening to on CNBC, is that if we're green 1% on Monday, that's just to reload puts. So now the sentiment's really changed, which I think is really, really interesting.
Yeah, no, it seems like there's always this agenda behind the media coming at. I know we did like
Definitely.
20 minutes of fucking conspiracy theories on last episode, but honestly, that was probably the most fun I've had recording a hot minute. But
yeah. You can find, if you guys ever want to find Dan, you could just go on different YouTube late night conspiracy.
No, you'll see like weird comments or like, what if Adolf Hitler didn't invade the Soviet Union? I'm like, are you sure this would happen? Like, are we positive?
Yeah.
Because in my,
if there's ever a YouTube documentary conspiracy theory coming out at 2 a.m.
No, just send it my way.
Yeah, Dan's waiting for Dan's one of the viewers waiting for the stream.
Yeah, no, when you see like 6 people watching, I'm one of them. Like at 3 Yeah, no,
exactly.
He wakes up the same time I go to bed. Like it's not
That's
good.
right. What was it? Thursday?
Yeah,
we were texting.
I was like, it was like 5 a.m. I was like, dude, I was ready to shoot some hoops. It's just like,
that's right. You did go shoot hoops, right?
I was gonna shoot hoops. Yeah, no, I just got a long phone call. I probably didn't deserve fucking being
that blows.
bamboozled. Yeah, you saw it. I talked to you. I was
did.
texting you, but I was like, what the fuck? This is going crazy.
Like, bro, hang up on this clown.
Yeah, I know. But, anyways, going back into the market, what do you think is kind of like, do you see anything upcoming that can affect it? Obviously, we just had the Fed meeting, and this is the first one. It didn't really seem like everyone was waiting for it or everyone was anticipating something or, hey, if this is good, if this is bad. And do you think it caught people by surprise, or do you think it's just like, we always got to respect these FOMCs?
No. For the next 16 months, anytime that the Fed is speaking, no matter what. And again, I mean, if Powell
when the market gets good, everyone's like, oh, fuck the Fed, dude. We're on our own. We're doing our thing.
Here's the thing: is that you even
ANC
heard
up fucking 50%, and they all just lost their fucking minds. They saw a ticker called Ape come out, and they fucking lost it.
Well, and here's the thing: is that even today, okay, Jackson Hole, okay, Powell started his meeting or like his talk with. Typically, I would talk about economic cycles, and don't quote me exactly, but it was basically like typically I would discuss past market trends. Economic cycle, stuff like this. However, and right when he said that, you just saw SPY. Zero. And
you see that transitional phrase in that comma. But
but because again, is that typically Jackson Hole is like a teaching seminar. It's like it's basically like
Jackson Hole is like my favorite fucking t-shirt brand right now. So.
Oh really? I thought you were gonna say
I'm pretty sure it's Jackson Hole Watering Company. It's like the only clothes I've been fucking wearing. So you're telling me it has all this shit to do with Diamond Cross? Yeah. That's my spot now. I'm a sucker for Instagram ads, dude. I thought I was bad at fucking Instagram ads buying t-shirts. One of my buddies, Cody, the one we interviewed, the lawyer guy, yeah. He keeps sending me fucking like 40 acres in Wyoming, 72,000. I'm like, dude, no, I'm not that much of a sucker for Instagram ads. Like, if you're finding land on Instagram, dude, there's something.
That's so funny. So essentially what I'm saying is that for the next 60 months, POW, CPI, stuff like that is going to be of the utmost importance. And we're really just going to have to keep it tight. And the thing is that going into this next week with SPY, Monday and Tuesday play small, because here's the thing is that 400 is going to be a big level. There's going to be a ton of chop. We're also going into the end of the month. So now, listen, now that the market's just given up about 3.3% here, and, we're about $25 from that 431 mark, this is where, now let's see what they do into the end of the month, because into the end of the month, I would suspect that they're going to try and keep the market up because, again, is that, they have to send out, banks have to send out client statements at the end of this month. So I think they're going to try and keep it up. And then, we could see a pretty quick movement into August down. And so that's kind of what I'm thinking. So Monday, Tuesday, honestly, even all of next week, I'll be playing really small. I'm moving to a new apartment. And I got to feel out the vibes there,
Yeah, no, you don't want to trade without knowing the vibe. If the feng shui's off, the trading's off. Look good, feel good, trade good.
I'll be right back inside this apartment in 10 seconds.
Yeah, no, you move right back, dude. Eli Manning's right upstairs. So,
Mark Wahlberg too, I found out.
Oh, Mark Wahlberg's in your building? Dude, I just got fucking like G Leaguers from fucking NBA. Like, I got like the Rockets G Leaguers in this bitch. James Harden used to live here, fucking taking everyone's girl. Thank God he's not here anymore. I'd be fucked.
Thank God. Yeah, I saw your Instagram story. Who's what's your name? Ava? Ivani?
I don't even think this is important. Anyways, a connection broke up. What happened? No, dude.
I meant to ask you. I mean, you don't really post many girls in your Snapchat story. But that's all right.
I'm just trying to look cool, dude. I don't even know. Anyway, connection broke up again. I don't even hear what you said. Nah. Yeah, I don't let dude.
Caught Dan slipping? Caught Dan slipping?
Dude, I don't slip, bro. It's not about how many times you fall, it's about how many times you get back up.
Yeah. I don't know. What do you guys think? You guys think we just caught Dan slipping?
Your boy's in love, dude. Fuck off.
Yo.
Oh, gross. No, sorry, I almost puked. So, where were we at? We were talking about what, stocks or something? Like Bitcoin?
Something
was
like
that
that.
crypto? It was hot in here. Man. My face right. So, I mean, you're seeing this, you're talking about chop and everything. You're saying play small. Is there any way that you think you can kind of take advantage of this, or does that just include being extremely risky? I mean, you're saying 16 fucking months. That's not a year and a half. I feel like we've been in this down market shit like 9 months now.
Yeah, I mean, until CPI is, I'll say, below 4%, that's going to be pretty important. The other thing is that, really until like until inflation is underneath control, it's going to be really important, because every single CPI meeting is going to be looked at with a fine-tooth comb, because again, is that inflation is so high. Think about this. If you have $100,000 and inflation stays here, you will only have 92,000. Like, think about, have you ever...
They're charging 10 cents for bags at the mall. I was like, no, just put that bitch in this bag. I got one.
Yeah, exactly. Like, so that's what I'm saying is that listen, like, think about how many, like for everybody listening, think about how many times in a single day that you've spent $8,000. Like, you probably count on your fingers, and most of it will probably be on a car or a house. Like, it won't be on, like a random, luxury item. Like, nobody's buying like 8,000. I guess some people are, but most people aren't buying $8,000, bags. And so that's my point, is that if you have $100,000,
bag let's just say $8,000.
Yeah, like, that's what I mean though, is that for doing absolutely nothing, you're losing $8,000. So that's why, I think it's important to understand the gravity that, like, yes, like we are inside a pretty big, I don't want to call it crisis.
I mean, you look at it's like looking at the comparative graph of like the minimum wage versus cost of living, and it's like boom,
ridiculous.
Boom. Yeah, no, it's like one stays the same.
It's like, no wonder we're only saving $4 per every 100.
Thank God we're bragging about saving 12 cents on Thanksgiving. Dude, I wonder what it'll be this year. It'll be like fucking the average price of a Thanksgiving dinner is like $76 per plate.
Per person. Yeah, per 3-year-old.
Dude, yeah, no, my fucking niece's nephew's not invited this year.
No.
Stay at the crib, dog. We got KFC.
Yeah.
All right, so in this week, for our segment of Back to the Basics, last week we did support and resistance. This week, we're going to do moving averages. Now, moving averages are super, super important for a multitude of reasons, but a lot of times what you'll hear is that a lot of traders use different moving averages. And the way that this kind of spiraled into moving averages being so prominent, other than just having, an indication of where the market was at some given period, was because when so many people are using so many different moving average, or, like the same moving average, well, that now just becomes natural support because of supply and demand. Let's just say that everybody's using the 20-day moving average, and they like the strategy of, watching it hold to 20, and then if it bounces off, they'll add into their position. So if 10,000 people are putting 100 share bid on the 20-day moving average for a starter, again, that's going to become natural support and resistance, which is really important, because then if it bounces off that line, then you're going to get more buyers stepping in for the exact reason. So this is kind of the way that moving averages really have evolved over the past however so many years. Now, obviously, moving averages are just important because they give indications about where the stock was. But I'll give you guys the Investopia definition, which is: a moving average is a stock indicator commonly developed or commonly used in technical analysis, used to help smooth out price data by creating a constantly updated average price. A rising moving average indicates that the security is in an uptrend, while a declining moving average indicates a downtrend. And then, I'll read this one, but we're not going to talk too much about it. The exponential moving average is generally preferred to a simple moving average, as it gives more weight to recent prices and shows a clear response to new information and trends. So what that said was basically, we have two different kinds of moving averages. We have what your brokers will typically categorize them as is super simple moving average and exponential moving average. Now, as Investopia just talked about, the simple moving average is going to be simply weighted across the time period. So a lot of times, if you have like the it'll just weigh across, evenly across whatever time period is, let's just say 20 days. Where exponential moving average is going to change the calculation around a little bit to give the price instead of like 20 days away the same weight, something that was 5 days away will weigh heavier than something that was 20 days ago. And sometimes this changes based on the broker and the calculation, but overall that's pretty much like the black and white version of this. Now, why is moving averages important, and which ones do I personally use? I personally like the 9, the 20, the 50, and the 200. And most of the time, that's just because these are commonly used moving averages. Again, that I don't necessarily trade with them or trade using them. However, I know that if a stock is coming down to the 9 or the 20 EMA or the SMA, that there's probably going to be some bids there from traders who like to use the 20 and the 9, and of course the 50 and the 200. Now, the other thing, and you'll hear as we talk about, we've talked about it multiple times, is that one of the reasons that I like moving averages the most, other than knowing what other traders are looking at and just giving an indication, is also because I like moving averages because, as the article just talked about, it gives a sense of what kind of trend that particular stock or index is in. So this is why we talked a lot about over the past few weeks that I want to see the 50, the 200, the 20, the 9. I want to see them all curling up towards the sky. When they're pointing at the sky, that's a really good sign, and especially when they're not crisscrossed and all over each other. So I personally like when moving averages are nice, they're crisp, they're clean, and it doesn't necessarily need to be an uptrend. It can also be a downtrend, and I'm okay with that. But like I said, is that I don't really want like the 200 and the 50 to be crossed. I don't really want the 9 and the 20 to be pointing in different directions. That doesn't really give like a good indication. So the overall goal, and this is kind of like what SPY did over the past few weeks, which was SPY came up, it crossed over the 9 EMA, it held, it went for the 20, it held, and then it kind of went through the 200. But I believe that now after this crazy SPY Friday, that is probably below the 200. So I'm okay with that because the 200 is so far out. However, like I said, is that the 20 and the 9 and the 50, typically I like them to be, parallel to each other, all pointing inside the same direction, not crisscrossed. And that's typically really bullish. And that's trend trading. And trend trading, you can make a lot. And if you were a trend trader, then over the past 6 weeks, you really capitalized on that SPY move. And if you want to learn more about trend trading, one of my favorite books in general, but especially for the market, and the book that got me into trading was The Complete Turtle Trader. And so I would definitely, I like the audiobook version, but I would definitely pick that up and listen to it because it's a really, really fantastic book. And I think that anyone, no matter their expertise, no matter their experience, that you can learn a lot from the Complete Turtle Trader. Now, I pulled up this website because I want to see what exactly kind of strategies people use for moving averages. Because as we talked about, is that I understand, the basic moving average strategies, but I wanted to see what like the quote unquote top websites say about moving averages and different strategies that they have. So this one is normalbang.com. Never heard of it, but it was the first one that came up. So let's see. So it says trading strategy. The 50-day moving average is a straightforward strategy. If prices graze the average as support and then bounce back, a trader can buy a stock. If the price rise at the average as resistance and pull back, a trader must consider selling or shorting the stock before a further decline. The primary reason is that it takes a lot of buying interest to push the price back above the 50-day moving average. A trader can enter when prices come out of the 50-day moving average and in the direction of a breakout. For example, if there's an uptrend, a trader can buy at breakout levels and short it when the price rises. Usually it takes time to reverse the price trend from the direction it broke out in. A trader can set a stop loss in the opposite direction to reduce losses. The stop loss plays a vital role, blah, blah, blah. Okay. So pretty much straightforward. It's what we talked about, at the very beginning of this segment, which was, again, is that, I feel that a lot of different traders, depending on what side you're on or what side you primarily like to trade on, will typically set bids right above or below the 50, as a starter, and then they will add into it or cut it for a small loss, and so the 50-day is a great representation of that. And I think, that a lot of traders do that. I was looking for a little bit more of an in-depth strategy than that. However, yes, that is one way to do it. Now, the only thing with that is that you really, really need to be disciplined, because a lot of scenarios that I'll see happen with different traders is that, let's just say that you're using the 50-day moving average as support. I'll see a lot of times where the 50, or let's say that you're using it as resistance and you want to buy it as a breakout. Okay. So what I'll see a lot of times is that I'll see the price come up to the 50-day moving average. Someone, will fill right over the 50-day moving average, thinking that, okay, it's broke the 50-day moving average. This is now support. And then what I'll see is that because they're using too short of a time frame, let's say the 5-minute, the 15-minute, something along those lines, they will see the price duck underneath the 50 and then sell for a small loss. And that's where, just because on the 5-minute or the 15-minute, it crossed underneath and underneath the 50-day doesn't necessarily mean that it's going to close there. Because again, just because the 5-day it went down there, on the hourly, it could wick down there and then wick back up. So typically what I would do, and what I have done, is that if I'm going to use the 50-day, again, let's just say as resistance, if the price breaks through that point, I'm not going to set my stop loss super close. What I'm going to do is that I'm going to say, okay, unless the market really takes a dump like it did today, I'm talking about Friday, August 26th, then what I'm looking for is that I'm going to wait till 3:30 p.m. before I sell it. So that's going to be kind of my stop loss, is that if we're underneath the 50-day moving average, at 3:30, 3:45 Eastern time, right before close, then I'll consider selling it. However, let's just say 1 o'clock, we duck down and right below the 50-day moving average, I'm going to set my stop loss like 1% below that, so that I still have my stop loss in place, but it's not going to be one of those situations where, because again, I like trading on the 5-day, that if the stock or the index gets absolutely smoked, I'm still have that stop loss in place. But at the same time, if market makers play different games right around the 50-day moving average and they want to chop it up and down around there, I'm not going to get stopped out 10 times and then when it rips, me chase it up. So that's a really good way, in the way that I use to ensure that, again, I don't get stopped out, just for when it chops. But at the same time, if market does dump, most I'm risking is 1%. And again, that's not 1% on my portfolio. That's 1% on my position, 1% on my starter, whatever it is. And that's a really good way to take risk reward. Now, if you have like a high beta stock, maybe you go 2 to 3%. If you have a high beta stock, and it goes 2 or 3%, that's okay. But if it's like the indexes or, something like a lower beta stock, then 1% is totally okay. And yeah, so that's the 50-day moving average. Let's see what else we can find. Okay, so this is funny. So I just opened up a random, and this one was trading with Rainer. or something. And so I just scrolled down, I was skimming a little bit, and I like this one. So how to use the title of this article is how to use the 50-day moving average to ride massive trends and not get stopped out on minor pullbacks, as we just talked about. Let's see if Rainer agrees with what I said. So it says, when it comes to riding trends, even with the 50-day EMA, many traders get stopped out on the slightest pullback. Why? Because they trail their stop loss too tight. Okay, great. And then he goes on to continue, and this come out. It's kind of like chasing a girl. If you stay too close to her, she'll run. But if you give her space, you've got even better odds of winning her over. So how do you fix it? I really like that. Honestly, Rainer, I'm about to message Rainer and find him on Twitter. I like his analogies. And so then he can tell us, well, you've got to learn how to let go and give your trade room to breathe. And one approach is to use the 50-day moving average to trail your stop loss. This means if you're long, hold the trade as long as the price remains above the 50-day moving average and exit only when it closes below it, and vice versa for the short. So here's the thing. So this is why, okay. So the only issue with that, and I see what he's saying. He's basically saying that if the 50-day moving average, if the stock, let's just take SPY. If SPY closes below the 50-day moving average, then you get stopped out. However, if it doesn't close, no matter what, if it doesn't close below there, then you stay inside the trade. And my only argument to this, and the reason that I typically like to what's the word I'm looking for? The reason I like to wait until 345, because the issue that can arise with that is, let's just say you're inside SPY and it closes right at the 50-day moving average. Well, what happens if it gets absolutely smoked the following day? Well, like, let's just take even this Friday. Like today, August 2026. What would have happened if you waited until Monday, like this candle isn't technically closed yet, or I guess actually at the time of this recording, it is closed. But what, I'm going to give up I'm going to give up 3.3% in profit? No, I'm not doing that. So that's the only argument that I see. And then just to, kind of clarify my thoughts like this is that the only issue with waiting for the daily candle to close is that what happens if we have a 3% down day like we do today? That's a situation where, the 50-day moving average might be 2% higher than where we closed today, so then you're giving up all of that. So that's why I typically like to stay on the 4-hour or like the 4-hour chart or the 1-hour chart and it closed below there, because again, it would be crazy if the market went down, 3% in an hour. I guess, again, of course it's doable, but that's just a way where you kind of use something to, some discretion to your trades, because again, is that if you get into a situation where you're waiting till 4 o'clock and the market might be down another 2%, 3%, and so that's a lot, especially when you consider that the market typically only makes about 8% a year. I don't want to wait for that. So that's just a reason that I typically I'll be loose with my stop, but it won't be one of those situations where I will 100% wait until the daily is closed. Like if we're really getting 1 or 2% below, that's not going to climb back. It very rarely would it climb back, and I'm okay inside that situation. If I stop out and then somehow we go down more and then we climb all the way back in same day, I'm okay with then entering, let's just say like the following day or something like that, once the market proves itself a little bit. So that is back to the basics. That's moving averages. Let us know if you guys have any questions and we will follow up with them next week. Sorry, guys. One last thing that I forgot to mention that I wanted to make sure was in there was the issue with moving averages. So we went over a little bit about like how we can use moving averages to our advantage. That a lot of traders like to use the 9, the 20, the 50, the 200, which can put bids in at that price. And even if it's not support, create support, because again, a lot of people are using that different moving average, as a point of to buy or to short or, whatever it might be. So, but we didn't really talk about the drawbacks. And so the drawbacks with a moving average, like we talked about with RSI, is that it is a lagging indicator. And so what's that mean? That means that just because the moving average was said price does not indicate future results. So again, as I talked about inside the beginning of the episode, is that I really like when moving averages are not crisscrossed, when they're all pointing in one direction, because that just gives a really clear trend. Well, just because that trend is following that now doesn't mean anything. I mean, realistically, it really doesn't mean anything. Great, it's following that trend, but it really depends on what level you are looking at this trend. Because again, is that all it takes is like some day like this Friday to really screw up the trend, and then you're just screwed. Because again, if you're a trend trader, then you probably wait until 4 o'clock to close your position. Or hell, some traders I know, they'll wait for the daily close and then they'll wait for the following day market open to see if it recovered one way or the other. So that's a situation where I don't want to get into the messy of it, saying like, oh, like the trend is up, the trend is up, the trend is up. Because again, is that the moving averages, like you'll see that, especially if you use in like larger time frames, that the moving averages, it'll take a lot for them to move in one way or the other. And then, you don't want 3% movement to then change it. So that's kind of like the caveat there, is that it is a lagging indicator. And so therefore, it doesn't necessarily mean that it doesn't mean anything. It's just showing the current trend. And again, is that it really depends what time frame you're using. Because if I were to use, up until today, if I were to use the last 4 weeks, you would have shown a massive uptrend. If I were to use the last 8 months, you're still showing a downtrend to a certain degree. So that's just last thing I wanted to add in there before we called it a day. Thanks, guys.
Pennies Going in Raw is a production of iHeartRadio. For more podcasts from iHeartRadio, visit the iHeartRadio app, Apple Podcasts, or wherever you get your podcasts.